Welcome. We're here to conduct a deep dive analysis into NVIDIA's third quarter results for fiscal year 2026. Our focus today will be on deconstructing not just the performance, but also the underlying strategy, and importantly, the significant risks that are now emerging in the broader ecosystem.
We're going to begin with our conclusion right up front. Our entire analysis really centers on three core findings. First, we'll talk about the quality of NVIDIA's financial performance. Second, we'll look at the fundamental market shift that's fueling this incredible growth. And third, we'll examine a new category of external, systemic risks that this very growth has now created. So, to ground our analysis, let's just look at the headline figures from the latest 10Q filing. The numbers themselves are, frankly, staggering. You're looking at revenue up 62% year over year to over $57 billion just for the quarter. And net income shows a very similar 65% surge. These figures really set the stage for the deeper investigation we're about to undertake. So, here's how we'll break this down. We've just covered our core findings. Now we're going to move into a very detailed deconstruction of NVIDIA's profitability. Then we'll examine the market's paradigm shift. And finally, we will assess those emerging headwinds. All right, let's dive in. To really understand the quality of this financial performance, we have to look beyond just the top-line numbers. So we're going to employ the DuPont framework to break down shareholder return into its fundamental drivers.
Now, this model is an incredibly powerful tool because it separates return on equity into three distinct levers. It really lets us see precisely how a company is generating returns. Is it through high margins? Is it through the efficient use of its assets? Or is it simply by taking on more debt? Now, what's really fascinating about this slide is the story it tells. On the surface, you see return on equity exploding from about 21% to over 119%. But the composition of that return has completely transformed. Let's break down each of these components to see exactly what's happening under the hood. The first and by far the most powerful driver here has been this monumental surge in net profit margin. We're talking about a jump from 16% to over 52%. That is a direct reflection of immense pricing power on its H100 and its new Blackwell systems, something you rarely, if ever, see at this kind of scale. This incredible profitability is then coupled with a sharp increase in asset efficiency. The asset turnover has more than doubled. What that means is that every dollar of assets on the books is generating significantly more revenue. This is a direct result of their fabless business model, which allows revenue to scale far, far faster than the asset base required to support it. And this right here illustrates a crucial point. While profitability and efficiency were absolutely soaring, the company's financial leverage, measured by the equity multiplier, has consistently decreased. Now, unlike so many high-growth firms that borrow heavily to expand, NVIDIA has actually deleveraged. It's funding this historic expansion almost entirely from its own operations. This points to an exceptionally robust financial position. So how does this all build up? Well, this incredible financial performance isn't happening in a vacuum. It's really underpinned by a strategic pivot in the AI market itself, a fundamental shift from the cyclical work of training massive models to the constant ongoing work of deploying them at scale. This slide contrasts the two core AI workloads really well. Think of training as the intensive, periodic process of creating a model. It's like a massive, one-time construction project. Inference, on the other hand, is the constant, real-time application of that model for every single user query. This creates a much more durable, almost utility-like demand profile. And as NVIDIA's CEO noted on the recent earnings call, the market is moving toward what's being called agentic AI. Now, these are systems that don't just answer a single question. They can perform multi-step reasoning to complete very complex tasks. This evolution exponentially increases the computational demand for continuous inference, solidifying it as the new engine of growth. However, this unprecedented growth is not without significant systemic risks that are now coming into focus. So a full analysis really requires that we assess these headwinds objectively. We identify three primary headwinds. First, the profitability of the AI applications themselves. Second, the financial sustainability of NVIDIA's largest customers. And third, the unavoidable impact of geopolitics. The first risk lies with the end users of this massive infrastructure. We're seeing reports that suggest even the most popular AI applications are currently operating at a significant loss.
So if the application layer of the AI economy fails to generate a positive return on investment, then the immense capital outlay on infrastructure eventually becomes unsustainable.
And this leads us directly to the second risk, a dynamic we can call the GPU debt system. What's happening is that customers are taking on substantial long-term debt. We're talking 10 or even 30-year bonds to finance technology purchases that depreciate in just 3 to 4 years. This mismatch creates a significant financial risk for NVIDIA's entire customer base. And the scale of this is just massive. Projections are showing that the top cloud service providers are on track to spend $600 billion on capital expenditure in 2026 alone. Now, while this fire hose of spending is driving NVIDIA's current revenue, it also exposes the entire ecosystem to risk if customer cash flows can't service that associated debt over the long term.
And finally, the geopolitical landscape has shifted definitively. As this chart starkly illustrates, revenue from specialized chips that were designed for the China market, like the H20, is now almost negligible. We're looking at about $500 million compared to $57 billion in total quarterly revenue. The decoupling is no longer a forecast, it's a present reality.
So the crucial point is this. We are witnessing a company that is executing its strategy with near-perfect operational and financial discipline. And yet it operates within an ecosystem that is, at the same time, demonstrating very clear signs of potential fragility. And this leaves us with a critical, forward-looking question. As NVIDIA builds the infrastructure for the entire AI economy with flawless efficiency, has the primary risk now shifted? Is it no longer about the company's own execution, but rather about whether the world it is creating can generate enough economic value to sustain the very engine that powers it?